I hope you saw the video I did last week on chart industries. This has all evolved from a course that I'm involved in from Goldman Sachs. It's geared to help me grow my business, but what it's basically teaching me is that companies grow as they identify growth opportunities. And if you'll read the white paper that I've written on our website, bestofusinvestors.com, on chart industries, and watch the video I did last week, you'll see they have identified an opportunity to grow within the expanding data centers, and they're going to grow exponentially as a result of that. And then I've come across another one called ACM Research. They're in the semiconductor business. They make systems that clean the wafers in the semiconductor manufacturing process, and they are what I consider a depressed stock because of the high interest rates. You haven't been buying new computers and new phones and new refrigerators, and so semiconductors, other than Jensen's GPUs, are somewhat depressed at this time, and their stock values are down. Well, this company, ACM Research, is in that same wafer process, very similar to AEHR Systems, which is another growth opportunity stock that I've covered, and there's another white paper on that on our website. But the gig against ACM is that a tremendous amount of their business in the past has been focused on China, and they have, as the industry is showing opportunities or regrowth opportunities, they're diversifying and doing more work now in Europe and in the United States. As a result of that, and what I look for in growth opportunities, and this is what Goldman Sachs has taught me, is a company goes through a process. It sees an opportunity. It goes through a projection process of, okay, if we seize this opportunity, what are the growth elements and what are the profits that are going to come to our bottom line? And that's what they do. So that's what Amazon, Google, and Microsoft are doing relative to GPUs. If we spend this money, will it end up hitting our bottom line? And that's what AMC has done. And as a result of that, they said, yes, we are getting orders from the United States. We can diversify our business. We can capitalize on this new AI interest in semiconductors. And in order to do that, we don't have much debt. We'll take on a little bit of debt, and then we'll increase our workforce so that we can facilitate and implement this growth opportunity. So what I look for is companies who are increasing their headcount. And the ACM has increased their headcount from 877 to 1,209. That was in 2023. And then in 2024, they upped it to 1,590. That's a 32% increase in just the last year. Well, what do you need 32 more percent people to do? Well, you need them to facilitate this growth process. Now, as a result of that, their revenues in the last year are up over 100%. But yet the price of the stock is not reflecting that because Mr. Wall Street isn't attuned to that as of yet. So they have put in place these AI-driven solutions, and they're taking their product and innovating it for its wafer protection and its wafer packaging, and addressing the 5G, the electric vehicle, the phones, the things that you will be buying, and as inflation comes down and as jobs go up, as benefiting from artificial intelligence and the economy thrives, this company, AMC Research, will thrive with it. So then what I do is I go and analyze and say, okay, if it's a depressed stock and it's got a PE ratio currently of 13.18, that's the price to earnings, but its 5-year average PE ratio is 37.64. That means the PE ratio is currently half or more than half down from what it was. So when it when it comes back into its stride, that PE ratio will go up. And thus, for every dollar of earnings, you'll get a 100% 2 times multiple on their price of stock. So then I also look at their revenue growth from 24 through the projected revenue growth between now and 2027, and it's projected the revenue to grow at 70%. So, and as I told you, this last year it grew at 100%. So this is a company that is on fire. So what I do is I create this an analysis that says, okay, based on its current PE ratio and its current projected earnings growth, what is the price going to be in 24, 25, 26, and 27? Okay, then what I say, okay, is if that growth in earnings doesn't multiple at 13.8, but instead of 37.64, what is the price going to be? Well, it's going to be in 2027 at the 13.18, it's going to be $27.81. It's currently at $21.10. But if it gets back to its 5-year average PE ratio, the price is going to be $79.42. Wow, some fantastic growth. So then I use another multiple and say, okay, what is its enterprise value at its current multiple of 1.9 as opposed to its 5-year multiple of 5.6. And again, I see that at its current multiple, its price will be $36.53, up from 21.10, or at its 5-year average multiple, the price will be up to $91.48. I put this into a chart and I share it with my people, and you make a decision. Is this a growth company that you want to be a part of, that you see some potential in, and that will dwarf the growth of the other stocks that we have in our portfolio who are also taking advantage of a growth opportunity? Who are they? Again, that is Google, Amazon, Microsoft, and Meta. What's their growth opportunity? Well, they just spent over $2 trillion on GPUs from NVIDIA, which made NVIDIA the fastest growing tech stock of the past year. And so they are basically saying, we're willing to spend this $2 trillion because it will produce a growth opportunity for us in the future. And that's how you really need to look at stocks from this point on. Do not just get caught up in what Jerome Powell is doing and what Janet Yellen is doing and who's going to become president of the United States. Recognize growth opportunities. How these people are taking these opportunities and monetizing them so that they generate sales growth of 100% a year, or revenue growth, that then translates relative to its gross profit margins down to its net profit margins, which brings profits to the bottom line, which multiplies against their PE ratio and drives their stock price up. That's how simple it is. And again, I want to emphasize, this is not something I've invented. This is what the hedge funds and Wall Street have been doing for years. But for years, you and I didn't have access to the data. I could not have put this chart together. By God, I would have had to get a copy of their past 5 years annual reports, go through their reports, find out what was their employee count back 3 years ago, 2 years ago, 1 year ago. And then in order to do that, I would have had to have the last 3 years annual reports. But I don't anymore. I can just go to the internet, subscribe to a service, and it gives me all that information. I then bring it over to a Google Sheets. As they hold an earnings call, I go to the earnings call, I listen to the earnings call, I copy the earnings call transcript, I put it into AI, and I say, translate this for me, put it in conjunction with my numbers, and let's figure out where this stock is going. That's where we are today. For those of us who understand AI, who understand data, and can interpret it, and then make it available to you. What does this cost you? we've brought the price down to $19.99. I think that's what it is a month. That's not my part. My part is writing the music and singing the songs. I make the videos. I do the research, and then I share it with you. Then you go to the website, and that's what Trent does. He builds that website. He offers my data to you at a ridiculous price of $19.99. I mean, if you subscribe to all the services that I subscribe to get this data, you'd be paying somewhere in the neighborhood of $500 a month. But what? I give it to you for $19.99. I'm Kerry Grinkmeyer. I'm a retired financial advisor. I'm enrolled in, I just got off the phone with the people from Goldman Sachs, and I was going over this with them, and they said, let's schedule another call. Talk to you again tomorrow.